If you're an investor, you know the feeling. That knot in your stomach, that mix of pure adrenaline and absolute dread as you watch the charts. You know, whether you're trading crypto at 3 in the morning, watching the opening bell on Wall Street, or holding on for dear life as a stock you love goes on a roller coaster ride. It's always this tightrope walk between life-changing opportunity and devastating risk.
And to really understand the wild markets we're navigating today, from forex to crypto and beyond, we have to look back. We have to understand a financial tsunami that hit almost 100 years ago, a disaster so big that its aftershocks are still baked into every financial law, every regulation, and every crash we've seen since. We have to go back to 1929.
So, I want you to just picture this for a second. It's the 1920s in New York City. They called it the Roaring Twenties for a reason. The city was electric, jazz was spilling out of every club, and new cars were everywhere. There was this feeling in the air, this infectious optimism that a new golden age was here to stay. And the beating heart of all that excitement was the stock market. And it seemed like everyone, from the titans of industry down to the typists in the office pool, shared one simple, powerful belief: stocks only go up, period.
And I bet that sounds a little familiar, doesn't it? You've probably heard the modern version. Maybe it's Bitcoin is definitely coming back, or the market's too big to fail, or that old classic, you can't lose money on real estate. It's this funny thing that happens, right? When the charts are all green, suddenly we're all financial wizards. But back then, there was something else going on, something far more dangerous. Pretty much everybody was investing with borrowed money.
This thing called buying on margin became the hottest trend, and it was so popular because it was so simple, so seductive. Okay, so let's break it down. Let's say you want to buy $10,000 worth of stock. On margin, you didn't need 10 grand. You only had to put down a tiny piece of it, maybe $1,000, just 10%. And the other 9,000? No problem. You just borrow it from your broker. I mean, it felt like a cheat code for the market, a golden ticket to getting rich, and getting rich fast.
And the upside, oh man, it was just intoxicating. On that $1,000 investment of your own money, if the stock just went up 10%, you doubled your money, 100% return. But here's the catch, the part everyone just kind of chose to ignore, the brutal reality on the other side of that coin. If that same stock fell by just 10%, your $1,000 was gone, completely wiped out. The very weapon that was making people millionaires in months was the same exact one that could and would absolutely obliterate them in a matter of minutes. So what happens when an entire economy is built on this shaky foundation of debt and speculation? Well, it doesn't take much to bring the whole thing crashing down. To really get this, let me tell you about a woman named May Cushing. She was a typist, a totally normal, middle-class working woman in New York. And just like millions of others, she bought into the dream. She started putting her savings into RCA stock. That was like the Amazon or Tesla of its day. And as the stock kept soaring, she got more confident. She put in all her savings, then she borrowed from friends, and finally, she took that last fateful step. She started buying on margin, betting everything she had on that one belief that the price could only go up. And then, it happened. October 1929, the music just stopped. It started on October 24th, a day that went down in history as Black Thursday. The market didn't just dip, it fell off a cliff. Panic started to ripple through the floor. Brokers were screaming for margin calls, forcing people to sell to cover their loans. But that was just the warm-up act. The main event came 5 days later, October 29th, Black Tuesday. It was a bloodbath, complete and utter chaos. A record 16 million shares were dumped in a single day. The ticker tapes that printed stock prices fell hours behind. The phones were ringing off the hook with one frantic command: sell, sell at any price, just get me out. Think about this. In a handful of days, the U.S. stock market lost almost 40% of its entire value. 40% of the nation's paper wealth just vanished into thin air. For Matthew Cushing, that RCA stock she'd bet her life on collapsed from over $500 a share to less than $30. And just like that, she and millions of people just like her had lost everything. And listen, this wasn't just some market correction. This wasn't a dip. This was the trigger. This was the opening scene of a decade-long economic nightmare. The fever dream of the Roaring Twenties was officially over. What took its place was a landscape of failed banks, shuttered factories, mass unemployment, and the longest, deepest, and most painful economic depression in modern history.
Okay, so you might be thinking, that's a crazy story, but that was almost 100 years ago. What does that have to do with me and my portfolio today? Well, it has everything to do with it. Because if you're an investor, this isn't just a history lesson. Because history doesn't just rhyme. Sometimes it's an almost perfect and very unsettling echo. The patterns just keep repeating.
Let's look at the first echo. That blind faith everyone had in RCA stock? It was virtually identical to the dot-com bubble in the late 90s. Back then, the belief was that any company, it didn't matter if they made a profit or even had a real product, would be worth billions as long as you just slapped a .com at the end of its name. The tech was different, radio versus the internet, but the human psychology driving it, exactly the same.
And then there's the second echo, 2008. The weapon of choice wasn't margin debt. This time it was subprime mortgages. But it's the same story with different characters. You had easy credit fueling a massive asset bubble, but this time it was in the housing market. People were getting loans they could never afford to repay to buy houses at prices that were completely disconnected from reality. It's the same fundamental mistake, just playing out in a different arena.
But maybe the clearest, most recent echo, the crypto collapse of 2022. That unregulated, Wild West vibe of the 1929 market was practically a mirror image of the crypto space before Luna and FTX imploded. It was new, it was exciting, it was almost completely unregulated. Hype was everywhere. Nobody really understood what was going on under the hood, and greed was just sprinting way ahead of common sense. The collapse of Luna, which vaporized billions of dollars in days, was our generation's RCA.
So you see the pattern, right? The assets change, stocks, houses, digital tokens. The technology changes, ticker tapes, the internet, the blockchain. But the one thing that never ever changes? The engine that powers every single one of these bubbles and every single crash that follows is us. It's human psychology.
And this psychological roller coaster is timeless. It always unfolds in 3 predictable stages. Stage 1, euphoria. Prices are soaring and everybody who's buying feels like an absolute genius. They start confusing a bull market with their own brilliance. Then we hit stage 2, delusion. This is where it gets really dangerous. People start saying the 4 most expensive words in investing. This time is different. They convince themselves the old rules don't apply anymore, that prices can't possibly go down. And that leads us, inevitably, to the final stage, collapse. Some event happens, it triggers fear, and that fear spreads like a virus. And the same crowd that was popping champagne just weeks before is now stampeding for the exits, causing a panic that ruins almost everyone.
Look, the reason we're digging through all this isn't to scare you out of the market. Not at all. It's actually the opposite. It's about arming ourselves. By seeing these patterns, by understanding them, we can learn clear, actionable lessons. Lessons that were forged in the fire of 1929 and are just as critical for us as investors today.
So what's the survival guide we can pull from the ashes of 1929? Here it is. Number 1, never ever go all in on a single asset. Diversification is your best friend. Number 2, debt is a double-edged sword. Leverage is awesome on the way up, but it will kill you on the way down. Number 3, don't buy something just because of FOMO. When your barber and your Uber driver are giving you stock tips, that's often the point of maximum danger. 4, no market is invincible. I don't care what it is, nothing goes up in a straight line forever. 5, regulations aren't just there to annoy you. They exist to save the entire system and you from our own worst impulses. And finally, number 6, and this is the big one, your knowledge is the most valuable asset you will ever own. Understanding history, understanding the rules of the game, that is the only real sustainable edge you have.
And that brings us to the final and maybe the most humbling lesson of all. The market is never wrong. It's a force of nature. We are the ones who are wrong when we get greedy, when we get arrogant, when we ignore risk, and when we start to think we are smarter than the collective madness of the crowd. The great lesson of 1929, the one that echoes through every crash since, is a lesson in humility. And if we can learn that, if we can learn to respect the market, control our own emotions, and actually learn from the ghosts of the past, then we give ourselves a fighting chance to not just survive the next storm, but to actually thrive.